Hans, what is really happening out there? Is it China spooking markets, or is it just in a corrective mode ahead of the big event, the Fed policy this week?
Probably a combination of both. The Fed is meeting this week, and I think investors are looking for cues whether they are actually raising rates in September. From what we can tell, there's a 50-50 chance. I mean, based on the US economy alone, a rate hike would be justified, but then the Fed has to look at the global economy as well, which they do, of course, and then they look at China, see what's happening there in the stock market. And that alone will probably not prompt a big mind change by the Fed, but the fear is that the market rout in China could have an impact on the real economy, and that's probably what will the Fed probably have to take into account.
Again, the opinion, as Aisha was saying, split there, because a bunch of people are already alleging, if I can use that term, that the GDP growth of 7% is not for real, it's up 6%. I'm sure these stocks will come in. My question is, yesterday we had two experts saying that the Chinese market crack and the performance of the economy are completely unrelated right now, because the market is showing a lot worse a picture than what the economy is. And even if you look at the markets, it's gained so much that this 20-30% fall also still makes China look a fairly decent YTD performing market.
Well, you're absolutely right. I mean, a market can be detached from the real economy for a very, very long time. In fact, in China, this has been the case for the last 7 years. The Chinese economy was growing at rates of 8, 9, and 10% 8 years ago, and the stock market did absolutely nothing. We only had this rally now over the past 12 to 18 months, and you could say it's a bit of a catch-up move, because the rest of the global markets have had a bull market during that whole time. So overall, you can say that now the Chinese economy is slowing and the market is going up. And you're absolutely right. I mean, we have a detachment from reality or from the real economy, because the Chinese equity market was basically, this whole up move was stoked by the government. They actually wanted to have higher equity prices, and of course a lot of margin debt. And I think the margin debt is really what's spooking them. The margin debt was about 9 or 9.5% of total market cap, and that's something that is very hard to correct, and it takes time, and it takes a lot of volatility, and that's what we're seeing right now.
Okay, let's travel west then, Hans. What's expected from the Fed this time around? Does it seem like a clear indication on whether it's going to be a September or December rate hike, or pushed back to next year? Are we going to see a definitive timeline?
Probably not, but the market is looking for some, some maybe clues or keywords. I mean, every word these days is dissected. It still looks, a September hike is about a 50% chance, as I mentioned. December, in our view, is unlikely, because the lift-off by the Fed will probably take place after a meeting where there's a press conference, and there's a press conference after the September meeting, not after the December meeting, and the Fed has never increased interest rates in December, simply because liquidity at that time of the year is relatively low. And after that, the next window of opportunity, a Fed meeting with a press conference, is going to be in the middle of March. So it's either September or it's going to be March. And this is the tough call here. I think the markets are a bit nervous about the September rate hike right now. Not that it comes as a huge surprise, but we've had many years of zero interest rates. And of course, it will lead to some volatility if the Fed actually raises interest rates.
Moot question, or the main question to my mind for the next 6 months right now, is that if indeed the global growth is in a bit of a tizzy, be it because of Europe, be it because of what's happening across the other baskets of the world as well, commodity prices are off, it's not that T-bills are going up in a hurry, where is the investment? Is equity still the go-to place, or would people now start preferring, say, maybe US bonds because of the expectation of a rate hike there, or some other instruments?
You see, you can look at all the other asset classes. Equities, on a relative basis, still comes out on top. You don't want to be in commodities right now, because if the Fed actually raises rates, the dollar is more likely to strengthen. It has strengthened already, which in itself is a policy tightening, but that will put further downward pressure on commodities. the bond market is probably one of the most overvalued asset classes in the world. So that leaves you with equities, which are not exactly cheap, but probably on a relative basis, much more attractively priced. If you take Japan as an example, where valuations are still relatively reasonable, you have a supportive central bank. Europe, we're bullish on. We're neutral on the US, but we're not negative. The uptrend is still intact. So by default, almost, equities come out as the top asset class.
Hans, one final word on India, because we too have been sort of facing the heat with some problems of our own as well with regards to P-note participation in Indian equities. What's the sense that you're getting about economies like India? Because commodities are on our side and a dip definitely tends to benefit economies like us. Should these cracks and dips be used as buying opportunities?
We think so. Within the emerging market space, India is probably the top choice here, simply because of the fundamentals. We have all the policy initiatives and everything. We have a consumer story, we have a growth story, probably the onset of a capex cycle at some point. Yes, of course you do have noise, the P-notes obviously that could be detrimental to sentiment. But overall, capital inflows have actually been positive in July, and international investors like India because it has potential to grow, and there's also potential for interest rates to come down. So this is an evolving story, and on a standalone basis, to us, is still very attractive.
Okay, Hans, good to hear that, and thank you so much for taking the time out and speaking with us. That's the view from Hans Goetti.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.